Hong Kong, it's one of the most important markets for Swiss watchmakers, and the protests that have unfolded there over the past few months have taken a toll on the luxury sector. So let's bring you up to speed with what the situation looks like right now. Take a look here. This is the 11th consecutive week that we have seen mass demonstrations. And just over the weekend, we also saw peaceful protesters out on the streets, about 128,000 people, according to estimates. During this period, retail sales have dropped about 6.7%, and this is expected to eat also into the July and August figures. Adding to the mix, we've also got hotel occupancy falling by about 20%. So where do Swiss watch exports fit into this whole picture? Well, the latest figures actually come out tomorrow, and we could see them ticking just that lower. Remember, last month there was already a significant drop of 27% in Hong Kong. This is critical, especially considering that Hong Kong makes up 14% of the Swiss watch market. And it's also Switzerland's 7th biggest export partner overall. Joining me to discuss this and more is Jon Cox, Head of European Consumer Equities at Kepler Cheuvreux. Now, to kick things off, we've got a melting pot of issues. We've got the trade situation, we've got the Hong Kong protests. Do you see now as one of the worst times to be a Swiss watchmaker?
Probably. I think there's probably parallels to the whole anti-gifting campaign we saw a few years ago in China. US-China trade concerns, the RMB is obviously very weak, so Chinese maybe not necessarily travelling anyway and buying abroad. You have this situation in Hong Kong, and then it's all compounded by looking what is likely to be a mild recession potentially in Europe and maybe in other parts of the world. So it's going to be a difficult second half, I think, for the watchmakers and maybe the overall luxury goods space.
So we did touch on it briefly just a moment ago, but give us some context here. How critical is a market of Hong Kong to Swiss watchmakers, and is this actually fading?
Yeah. No, I think if you look at Chinese generally, they tend to like watches a lot compared to maybe soft luxury goods. So the Chinese overall are a very important market. Then in addition, you have Hong Kong. It's a tax-free shopping destination. Watches on the mainland tend to be 30–40% more expensive than compared to Hong Kong. As a result, Hong Kong is around 14–15% of global demand for the Swiss watchmakers. So you can imagine if that market starts to fall 10, 20, 30, 40%, this is going to have an impact on overall demand globally for watches and have a negative impact, of course, on the likes of Swatch and Richemont and also into potentially LVMH and Kering and these other guys as well.
So if the importance of Hong Kong as a market does kind of fade away, what other markets do you see stepping up to fill in that gap later in the future? Yeah,
I think, you know, sort of short term, people may decide, OK, I'm not going to go to Hong Kong. I could go to Macau. That's also tax-free. If you look at sales taxes of places like Korea, Singapore, Japan, which already benefit from a fair amount of Chinese tourism, you can imagine potentially substitution, people going there instead. Part of the issue, of course, is the RMB. This could actually mean that a lot of Chinese decide to come into Europe rather than to go to Hong Kong as well. But it's going to be a bit difficult. I think when you get a shock like this, people saw the scenes last week at the airport. You're going to be cancelling your trips to Hong Kong. If you were thinking, I'm going to buy a watch in Hong Kong, you're not going to suddenly say, I'm going to go to Singapore tomorrow. So certainly, it's going to be bad for the next couple of months. I think a lot of damage has already been done for this year, even if things sorted themselves out in Hong Kong, you know, next week. Because I think you'll find that, you know, June, July, August, the retail sales of watches and jewelry will be down 30–40%. I think the Swiss watch export data will be down 30–40%. And as a result, you're going to see pressure on Swatch Group and Richemont stocks in particular in the next couple of weeks and months.
So let me just recap on that. You think it could drop 30–40%, because last month we saw a 27% drop, and that was already big enough to stomach.
Yeah. No, I think that was sort of like the first signs, well, there's something not quite right in Hong Kong. But with the export data coming out tomorrow, for example, would I be surprised to see a -30+ figure for July exports? Not at all. You're hearing reports from guys on the ground, watch producers that have their own retail operations. Sales have suddenly declined 20, 30, you know, up to 40% just in the last couple of weeks. So things are looking pretty grim at the moment.
So the bigger question is, how much is this really going to weigh in on the watch export figures over the next couple of months, not just tomorrow? And could this actually drag, in fact, into 2020?
Yeah, I think what I've done myself is cut my assumptions for global market demand from 5 to 2 on the back of expecting Hong Kong in the second half of the year to decline 20% overall. Now, it depends how long this situation goes on for. It doesn't look like it's going to be resolved anytime soon. A worst case could be, you know, the Chinese troops coming onto the streets in Hong Kong. We all obviously do not want to see that. That would then clearly continue into next year. In that worst case scenario, I'm expecting a 40% decline in the second half of this year, and then another 25% decline for 2020 as a whole. That's the worst case scenario.
Right, and the best case scenario?
The best case scenario would be a 10% decline still this year, because as I say, the damage has been done June, July, August. We'll see it in the figures. They've not been released yet, of course. And then maybe you get stabilization for the last couple of months of flattening. So overall down 10 for the second half of the year, and then up 5% next year. And that's the best case scenario.
Right.
So,
and I'm very curious to know, given this situation, is there anything in the arsenal of Swiss luxury companies to combat or help ease the effects that we are seeing? Or do they have their hands tied back, basically? Yeah,
it's difficult. As I say, if you've got, you know, such a big market, a shock to the system, people won't travel. They may delay purchasing, but the purchase, you know, the actual purchase of the watch can be lost. Obviously, they can try and cut down on their marketing in Hong Kong. You know, what is the point of having a big Breguet or Omega advert at Hong Kong airport, which may be costing you tens of thousands of dollars when you know nobody's going to come for the rest of the year? So they can move around a bit of marketing money. They can try and maybe advertise in those markets near Hong Kong where they think the travellers will be going to. In their own retail operations, you'll find that a lot of them are trying to deleverage so that the sales staff get commission on the amount of watches they sell, with maybe a smaller basic salary. Rents can be linked and stuff like that. But it's going to be tricky, and it's very difficult to do much in the face of just this shelving you see almost overnight when you've been going along maybe low single-digit growth to -30, -40, and potentially worse in the next couple of months.
So from experience, because you've actually been on Hong Kong ground before, you've lived there before, how long does it usually take for Swiss watchmakers to recover from such a situation? I'm talking, of course, also about the protests we saw in 2014. Can we draw parallels?
Yeah, 2014, you saw in the final quarter when a lot of the umbrella protest was happening, you saw up to a 20% decline in exports in those months. So October, November, December, down almost 20%. The following year is a bit difficult to try and extrapolate because you had the old anti-gifting, a second wave of anti-gifting, and actually you saw a stabilisation of flattening January, February, but then anti-gifting kicked in, and we saw again declines of 20, 30%. But from what I understand, talking to some of my colleagues in Hong Kong, basically, the situation today is worse than it was in the umbrella movement, not least because of what we saw at the airport last week. So, I'm not sure there'll be such a quick rebound given the nature and the seriousness of the current situation.
So let's dig into this. I mean, two of the biggest players are Swatch and Richemont. How do you see their exposure to the Hong Kong protests differing? Is one more vulnerable than the other?
Yeah, I think probably Swatch Group, with 12% of its revenue from Hong Kong, is probably, more overweight in Hong Kong. On the other side, it has almost 20% of revenue on the mainland. So if some people actually buy the watches on the mainland rather than Hong Kong, there could be some offset. But still, it's such a big market. Again, if you're falling 40, 50%, it's going to be very difficult to try and make that up in the mainland. Plus, the mainland is slowing because of what's happening with the US-China trade talks and uncertainty there. In the case of Richemont, they have about 11% of sales there. They obviously have more exposure into soft luxury, which has less exposure into Hong Kong and the Chinese region. They have the jewellery business as well, which is on a par probably in terms of exposure, so slightly less exposure from Richemont. And so Swatch Group is probably going to be worse impacted of the two.
How do these companies or these Swiss luxury giants actually stack up to other major players in the European luxury sector?
You know, if you looked in the last couple of years, clearly the likes of Kering and LVMH have done much better in terms of stock performance and consistently delivering double-digit earnings and typically double-digit sales growth. The watchmakers have been more volatile. It is a more cyclical business. It's a bigger ticket item. We're still suffering slightly from the hangover effect from the anti-gifting. In addition, in the case of Swatch Group, you have problem in the low-end watches because of connected watches. So clearly, if you're an investor, you would have done much better investing in the soft luxury in the last couple of years. I think if you look at the valuation, Richemont and Swatch Group look far more attractive. And from that perspective, I wouldn't necessarily give up on them on a 12-month view.
Okay.
But you can imagine the next couple of weeks and months, I think those stocks will be under pressure. I think the hedge funds will start circling. They'll be waiting for the data to come out. They know, if the data for overall is down 10 tomorrow because Hong Kong is down 30, 40, these stocks will be under pressure tomorrow.
So let's finish up on that note. Given this climate and that we are still seeing the situation in Hong Kong persist, are you still going long on luxury stocks?
Do you know, they've had a fantastic run overall, and up until a month ago, pretty much even Richemont had done 35% year to date. And I'd say, look, take some money off the table. The world looks much more uncertain today compared to, just a quarter ago. I'd be looking to take profits, to be honest, on the space overall. I don't want to say put your money in Nestlé instead, but you can see the way Nestlé's and Novartis and Roche are holding up compared to the watchmakers. They're going to hold up much better as we go into what is going to be a tricky final semester of the year, I think.